Okay, let's dive right into this. Welcome to our explainer on the ACCA Strategic Business Reporting Exam, or as we all affectionately call it, SBR. Now, if you're gearing up for this, you already know it can feel like a total monster of a syllabus, right? But here's the real secret. Passing SBR, it is absolutely not about memorizing every single page of that massive textbook. No way. It's all about strategic execution. So today, we're taking those raw study notes and transforming them into a highly structured playbook. We're going to decode exactly what the examiner is looking for, highlight the high-yield topics, and give you the tactical edge you actually need to conquer this thing.
Here is the highly structured, tactical playbook that's literally going to save you hours of study time. We've got 6 parts. 1, the SBR exam blueprint. 2, the high-impact IFRS standards. 3, mastering group accounting. 4, navigating medium-yield topics. 5, professional judgment is key. And finally, 6, final exam day strategy.
All right, Section 1, the SBR exam blueprint. Because passing SBR isn't just about math, it's about understanding the rules of the game.
Before we even think about looking at a single accounting standard, we've got to get our heads straight on this. I absolutely love this quote from our source material. Mastering the standards that the examiner tests again and again, not every page of the textbook. Seriously, let that sink in. This is your fundamental secret weapon against the SBR monster. It's the ultimate 80-20 rule in action. You've got to focus your energy on the areas that actually yield the highest return on your study time.
Let's look at how the examiner actually scores your paper. This breakdown of exam intelligence is absolutely crucial. Look at where the points are coming from. Sure, technical accuracy, getting the correct numbers, the right consolidation workings, the proper journals, that is the bulk of it. It's about 60 to 70% of your marks. But, and this is a big but, you cannot comfortably pass with numbers alone. Listen closely to this. 20 to 30% of your marks come from application. That means actually using the specific facts they give you in the scenario, not just, copy-pasting generic textbook definitions onto the page. And then there's that crucial 10 to 15% for professional judgment, which basically means explaining the why.
And this brilliantly illustrates the exact difference between simply scraping by and truly crushing it. A pass-level student? Well, they calculate the correct numbers and maybe, if you're lucky, throw in a reference to the standard number. But a distinction student, they go so much further. They explain the why behind that number. They discuss alternative treatments, note the required disclosures, and they actually demonstrate professional skepticism. They prove to the examiner that they understand the real-world implications of those numbers on the page.
Moving on to Section 2, the high-impact IFRS standards. These are the absolute heavy hitters of the syllabus.
Okay, so now that we know how we're being graded, let's look at exactly what topics we need to apply those skills to. Notice this clear Big Four breakdown for our high-yield topics. First up, group accounting, consolidation. This is foundational. It's literally in almost every single exam, so you simply must know it backwards and forwards. Then we've got financial instruments under IFRS 9. This is an area the examiner specifically notes candidates mess up, especially around those really tricky rules for classification and measurement. Next is revenue from contracts, IFRS 15. This one always pops up as a complex scenario, testing your ability to apply the 5-step model to, real-world commercial deals. And finally, leases, IFRS 16, where examiners report candidates frequently just forget to calculate the right-of-use asset correctly. Master these 4 slices of the pie, and you are well on your way to a passing grade.
Let's transition to Section 3, Mastering Group Accounting. This is your guaranteed exam topic. Let's zoom in on that first massive slice of the pie. Consolidating a parent and a subsidiary into one single economic entity is virtually guaranteed to be on your exam, and it requires a really methodical, step-by-step approach. The whole thing starts with IFRS 10 and the definition of control, right? To consolidate, you must have control, which requires 3 specific things: power over the investee, exposure to variable returns, and the ability to actually use that power to affect those returns. Now, examiners don't just want you to recite that like a textbook. They want to see you apply it to messy, complex scenarios. They want you assessing de facto control or looking at structured entities and making a real defensible judgment call.
So let's see how this builds into the consolidation process itself. These are your 4 pillars, and we really need to take our time here. Step 1, establish the net assets of the subsidiary at the acquisition date and at the reporting date. That sets your foundation. Step 2 is the goodwill calculation. So you take your consideration transferred, add the non-controlling interest, and subtract those net assets we just figured out. Step 3, calculate the non-controlling interest, or NCI, whether that's at fair value or proportionate share. And Step 4,
calculate group retained earnings. Just make sure you only take the post-acquisition share of the subsidiary's profits. Now, here is a massive, game-changing tip straight from the source. Even if your final number is completely, hopelessly wrong, methodical, structured workings through these exact 4 steps earn you solid method marks. Always, always show your work.
Section 4. Navigating medium yield topics. Because the Big Four aren't the only things that show up.
While the Big Four are your foundation, you really can't ignore the medium yield topics. These frequently pop up, usually to test very specific technical criteria. A perfect example is IAS 37 regarding provisions, contingent liabilities, and contingent assets. To actually recognize a provision on the balance sheet, you have to hit all 3 of these specific criteria: an obligating event, a probable outflow of resources, and by probable we mean greater than a 50% chance, and finally, a reliable estimate can be made. The classic examiner trap here, it's the obligating event. They absolutely love testing whether an obligation is purely constructive, like, say, a published company policy to refund customers, versus a strict legal obligation drawn up in a contract. If you don't hit all 3, you might just have a contingent liability, which you only disclose in the notes. Or, hey, if the chance of outflow is remote, you do absolutely nothing at all.
Another really great medium yield trap is IAS 8. The absolutely crucial point here is knowing the exact difference between a change in accounting policy and a change in accounting estimate. A change in policy, like let's say switching your inventory valuation from FIFO to weighted average, requires you to restate prior periods, as if that policy had always been in place. But a change in an estimate, like changing the useful life of a machine from 5 years to 3 years, that's treated prospectively. That means no restatement required. You literally just change it going forward. Oh, and remember, if it's just an outright error from a past year, you simply correct it retrospectively. Simple binary to remember. Policy equals restate. Estimate equals no restate.
All right, we've reached the climax here. Section 5, professional judgment is key.
We've talked about the technical rules, but now we really need to talk about the mindset shift required to actually impress the SBR examiner. This right here is where you secure your distinction. I cannot emphasize this enough. As our source material explicitly points out, SBR is 50% numbers, 50% justification. Don't skip the why. The examiner fully expects you to discuss why a particular accounting treatment is chosen, especially when IFRS allows for options or when a scenario requires significant management judgment.
So, I want you to actively ask yourself this question when you're grinding through practice papers. Are you just giving a number, or are you explaining the judgment? Think about it. If you calculate a massive write-down on an asset, are you stopping there? Or are you adding a sentence explaining that management must consider macroeconomic factors and changes in credit risk under IFRS 9? Actually, scratch that. It's not just a sentence, it's the whole rationale. If you want those distinction marks, you need to reference specific IFRS paragraph numbers and explain the underlying logic behind your calculations. Show them you think like a chief financial officer, not just a human calculator.
Let's wrap this up with Section 6, Final Exam Day Strategy, because it all comes down to game day execution.
Okay, we've covered the knowledge. Now let's talk about execution. You can know every single standard inside out, but if your exam day technique is poor, you're going to struggle to pass. I want you to memorize this number, 1.8. That is the golden rule of time management for this exam, 1.8 minutes per mark. Let's put that into perspective. If you're tackling a 25-mark question, you have a maximum of 45 minutes. When that time is up, you must move on to the next question. Poor time management is literally the #1 reason candidates fail. They get totally bogged down perfecting one single calculation, run out of time, and leave entire sections completely blank.
So, let's run through a rapid-fire final checklist to empower you for game day. Number 1, stick strictly to that time limit we just talked about. When the 45 minutes are up, drop the pen, move on. Number 2, show all your workings. Seriously, if you mess up a final addition but your underlying method was right, you still get the marks. It's basically 3 points. Number 3, use clear headings. Make it incredibly easy for the examiner to give you points. Label sections clearly, like goodwill calculation or consolidated statement of financial position. And number 4, grab those professional marks by structuring your answer logically and wherever possible, referencing specific IFRS paragraph numbers. It really shows off your deep technical knowledge.
You know the blueprint. You know the high-impact standards. You know exactly how to show your workings methodically, and you know you absolutely must explain the why. You've got the playbook. Now you just need to trust your training, rigorously manage your time, and show that examiner your professional judgment. You have the tools, so the only question left is, are you ready to execute?